Hi, this is Vlad with TradeSpoon, and I'd like to talk about the current market conditions. Implied volatility is up, and VIX has been elevated in the past couple of days. It still hasn't reached the historical levels that indicate bearish market, but we did have a sell-off in the past week. So what are the current market conditions that drive the market? It seems like we are driven by two forces. One is the earnings season. On one hand, we have a historically low earnings pre-announcement, where if you plot 3-year chart, you'll see that the earnings pre-announcements have been on the lower side. As of today, 25% of the S&P companies have reported earnings, and only 53% of them have beat already lowered earnings estimates, which is on the 3-year chart is historically low. On the other hand, you have FinMC open committee that is supposed to make a decision on how soon they should raise the earnings, raise the interest rates. And if the interest rates are raised earlier, that will put overhead resistance on S&P, and the market will not be going up as fast as it used to. So currently, as I'm having this conversation, S&P is up 100, Dow Jones is up 100 points, and S&P is up 10 points. So we're stuck between these two forces, and on one hand, we have lower earnings, and we're only 25% into earnings seasons. On the other hand, we have a federal committee that's supposed to meet for the next 2 days and decides how quickly they will raise the interest rates. So those market conditions, again, it's very important to diversify your portfolio and hedge your current positions. Last time we talked about options and options delta that determines how much option change for $1 change in underlying stock price. And when the volatility is high, it's also important to understand the acceleration of delta changes, which is called gamma. So gamma is one of those Greek letters that define how quickly does the delta change for $1 change of underlying stock. And when you have high volatility, like we raised volatility like you do now, and you have growth stocks, delta seems to be spread out among all the different strikes. And in the money, out of the money strikes, or at the money strikes, have a gamma that is evenly spread out. And so if you plot strikes versus the gamma change, you will see a bell-shaped curve where in the middle, at the money strikes on the low volatility have a bell-shaped distribution. But at a high volatility like we have now, gamma seems to be tend to be linear, because you already have factored in time premium into each individual strikes. So when you look in the probability of your trade to be successful, you have to choose the strike price that have a high probability of making money. And that tends to be 1 or 2 standard deviation out of the money. With elevated volatility and higher gamma, you're better off selling out of the money put spreads or out of the money call spreads and increase the probability of successful trade by selling premium. So once again, options is a great way to trade, to hedge your portfolio. You can find more research at tradespoon.com, and I think trading options is the way to hedge your portfolio. But before you do that, you do want to understand the delta, and you do want to understand what the gamma means and how does the option price changes for $1 change in underlying stock, and how quickly does the option change option delta change as respect to underlying stocks. Until next week, this is Vlad with TradeSpoon, and happy trading. Thank you.